Welcome to the Silent Trading channel. Today I'll be analyzing and updating the gold chart with you guys on Friday the 27th of February to see whether right now is it okay to enter a position from where we're standing. For instance, if the price right now is in a bullish price action side or is in a bearish or bullish trend, are we entering a buy position or are we entering a sell position? Right, so we'll go through all of this in detail. We'll be analyzing all of this in detail for version, right? But before I start, please subscribe, like, comment, and share if you like this video to support me in my trading journal and to support me in my guiding you guys on how I trade, right? So first thing first, I'll be starting on a 4-hour time frame or the 4-hour candle. As you can see in the 4-hour time frame, the chart, the market right now is in a consolidation phase, right? Or I'll call it a sideways. In this sideways frame, right? This triangular frame that I've drawn before it is even happening, I've drawn this because I've anticipated that the price, it is either going to break above, right? It is either going to an expansion or it is either going to into a sideways. But the problem is right now there is no price action available for you to enter a position. Because why? We don't enter a position in a sideways phase, because a sideways phase is the worst place to enter a position if you're not accurate enough. Because a sideways phase is when you enter a position and if the chart breaks above or if the chart breaks below, that chart is never going to come back to your order for you to close your position at break even. The chart is never going to come back to your order for you to break even, for you to close with as little loss as possible. Because why? Because a sideways phase or a consolidating phase is where the chart is in a balance zone, right? It's in a balance zone because there is no fair value gap, like you guys understand. There is always a clearing, a matching of orders from both sides, be it a sell or buy position. So in a sideways zone, when the price break out from a sideways zone, it is telling us that the market is accumulating the volume where it is breaking out. If it is breaking out above, it is accumulating sell side volumes from resistance, right? Be it a reversal resistance or a resistance that has a few time frame at that specific resistance, at that specific key point, and that is a key resistance or key support. So when price tries to break above, we know that the market is trying to accumulate sell side volumes by triggering sell limits at resistance, or triggering, right, by attacking resistance and triggering sell limits and triggering traders to enter a sell position by market execution, and then in a straightforward form break above, right, goes into an expansion and then start retracing and then goes into another expansion, right? So when price is in a consolidation phase or is in a sideways phase, I'll stop calling it a consolidating, I'll call it a sideways phase, right? A sideways phase is when the chart isn't looking to break anytime soon, isn't looking to go into expansion. Because why? Because most of the time when the chart is in a sideways, it is explaining to us, right? It is explaining to us in the form of a candle, in the form of a candle movement, that there are both buyers and sellers at each point in the chart. There are buyers waiting to close their position at break even above. There are sellers waiting to close their position at break even below. So which means if the chart is pressuring, right, pressuring by going to a sideways, never reaching the zone where there are sellers waiting to close their position at break even and buyers closing their position at break even, and that tells us something, that the chart is right now pressuring those position holders into closing the position. Which means if the chart is going to break above, the chart is going to need all buyers that are still holding on to their position to close out their position before the chart can break above, right? Because once buyers are out of the market, then the market can goes up. Once sellers are out of the market, only then the market can goes down. Which means right now, no matter buyers or sellers are closing out their position first, the market will never be in an disadvantageous position. Because why? Because this is the way the market is moving. I'll tell you in a short form. If sellers are closing a position first, right? If sellers over here are if sellers at the bottom are closing their position first, right? Because they are in a drawdown, right? They need to be able to close their position at break even. But if they believe that the market is not going to let them close their position at break even, sooner or later they'll close their position, right? And after they close their position and there are still buyers trapped above, right? Sellers trapped below has been taken out because sellers choose to close their position for fear of the market breaking above. And then when markets start to goes into a hard form of consolidating or a hard form of sideways, right? Pressuring at the most possible narrow gap that they are going to. And once sellers close their position, which means sellers are taken out, right? Which means sell side volumes are taken out, but there are still buy side volumes at this point over here. Once sell side volumes has taken out, right? People close their position at losing, right? Losing they close their losing position. Once that happens, the chart is going to break below. Why is it going to break below? Because once sellers close their position, there are no more sellers in the market, which means the market can go down because there will not be nobody be able to close their position at break even. But there are still sellers trapped above, which means the market is going to break below and then retrace and then break. Why is it going to break? It is going to break because the market is forcing buyers over here to close their position, forcing buyers over here to close their position. And once buyers close their position, the market is going to break below. Nope. Once the buyers close their position, they're going to be producing a reversal. But that is only until they have dumped down hard enough for the buyers to close their position. Or if the buyers are not closing their position, the chart is going to pressure until the buyers are liquidated, right? So only then after the buyers are liquidated and the chart start producing a reversal or a bullish price action, right? And if that bullish price action is valid, it is validated, only then when the next candle retracement is where we're gonna buy, right? So we need to be able to understand that why both buyers or sellers are always in a losing position, because the market has a way of identifying whether there are more buyers or whether there are more sellers, and the market tends to take out the side that has the most traders or the side that has the most volume first before taking out the opposite, right? Which means no matter which position you're holding, be it a buy or sell position, you're always gonna lose. Because why? The market understand that right now buyers are above, sellers are below, which means once sellers has closed their position due to pressuring, the market is gonna break below, right? The buyers is gonna be forced into closing a position. Because why? Once sellers close, market break below, buyers are also forced into closing, right? When buyers close, the market is going to reverse and then start pushing up again, right? And when the market start pushing up, sellers that have closed their position or sellers that has just opened a new account, opened a new portfolio, they'll think that the market has already has a change of character, right? By breaking support. And nope, sometimes they're wrong, because once the market has created or produced a bullish price action, and a valid bullish price action at that, and then start pushing up to attack resistance, right? And after attacking resistance means accumulating sell volumes. And once attacking resistance has started, the market is going to drop down to clear off buyers, but not touching support, because touching support means the market has started accumulating buyers. And once the market drop down, to clear buy side volume but not touching the next support, and then market start going up to attack resistance again and is able to break resistance, the next candle retracement is where we're going to start buying and we're going to go on a full-blown position, right? So if normally you're opening a position at about 0.1 lot, right, you can double that position or you can triple that position. Because why? Because this bullish price action is a valid one, right? So don't overlord, don't overtrade, right? Don't just jump from 0.1 to 1 lot to 5 lot. Nope, that is totally over trading. But you can multiply your lot by let's say, for instance, let's say you normally trade 0.1, right? You can up to 0.2, 0.3, but not more than that. Because why? Because more than that means you're risking more than you should, correct? But you're risking more from this position because this is a bullish price action and it's a valid one at that, because it has been validated by this candle, right? By this candle pushing up and breaking resistance, which means this bullish price action is a validated one, which means the next candle retracement you're gonna buy, and you can even snowball, right? So like I said, from 0.1 you can go to 0.2 or 0.3, right? Because you trust that this bullish price action has really been validated and is a valid bullish price action. And once you have entered a position, you wait for the next price action to happen. Is what? The next price action that is going to happen is for the price to break the resistance that it has created. And if the price or if the candle is able to break resistance, you're going to be holding on to that position for as long as you could hold on to, right? But if the chart goes up but wasn't able to break resistance, right, and then start pulling back down, your position should be closed at that instant, because pulling back candle means the chart is clearing off buy volume, which means the market are starting to have buyers accumulated into the market, which means the market is going to start clearing off buyers. So your buy position or your long position should be taken profit of. Why? Because you're waiting for the next price action to enter a new position. So at any specific zone, at any specific price action that you see, you're able to take action, be it entering a position or closing a position. Because if you understand the chart, if you understand the candle, you should know which position to close, you should know which position to hold on. But if not, the next thing you're going to be doing is to be learning, right? To learn how to hold on to position and to learn which kind of position you should be holding on to and which kind of position you should be closing as soon as possible. And this is what I'm going to be teaching you guys in the upcoming days, because I'll slowly be revealing more and more information, because there is a whole stack of knowledge inside my head that is ready to burst at any moment. And I'm trying to reveal all of this to you guys, for you guys to understand the chart, for you guys to understand each market movement. And by understanding, only then can you be trading consistently and being profitable consistently, because copying other strategy doesn't help much, but understanding that strategy and making it into your own strategy, making it compatible with you, it is the best solution to trading, right? So for today, we are not entering any position until the chart has shown us sufficient price action, which means you either wait for the chart to break above, right? Break above, break resistance, and then the next candle retracement you're gonna buy, or you wait for the chart to break below, right? You wait for the chart to break below, trying to clear off buy volume, and after clearing off enough buy volume and the chart create a bullish price action and then retrace, you're gonna be buying at that retracement. Or if you're not buying at this retracement, at least wait for the chart to push up to attack this resistance and break this resistance. And once the chart has break this resistance, which means this bullish price action is a valid one, is a complete one, and then at the next candle retracement we're going to start buying, right? So you either wait for the chart to break above and then pull back and you start buying, or you wait for the chart to break below and then create a new bullish price action before you start buying, right? So am I clear on all the condition and criteria to start buying and selling? So for today, that's all I'm going to be saying. And wait. You totally need to wait because everything matters. So for today, see ya.